Build your dreams, live rich, and leave rich.
Welcome to Live Rich and Leave Rich by Krish. Today, we're going to pull back the curtain on the world of mutual funds. Our goal here is super simple. Cut through all that confusing jargon and give you the clear, straightforward knowledge you need to feel really confident about investing. So, let's dive right in. Look, if you've ever scrolled through a list of mutual funds and felt your head start to spin, you are definitely not alone. I get it. All these terms, large cap, flexi cap, gilt, hybrid, it can feel like learning a whole new language. But trust me, figuring out what these words mean is the very first step to really taking control of your financial future. So let's start with the basics, right? The first big step is just getting a handle on the main categories of mutual funds. You can think of these as the main food groups of investing. Each one is defined by what it actually invests your money in. First up, we've got equity funds. Now, what are these? They're funds that buy stocks, which are basically just tiny pieces of ownership in companies. Their whole goal is growth. They're trying to make your investment worth a lot more over time. But, and this is important, you have to remember that with the chance for higher returns, you also get higher risk because the stock market has its ups and downs. Now, within equity funds, things get pretty interesting. Think of it like this. Large cap funds invest in the big, stable giants of the business world. We're talking lower risk and steadier, more predictable returns. Then you have mid-cap funds. These focus on companies that are really in their growth spurt. A little more risk, sure, but also the potential for higher growth. And then there are small cap funds. These guys invest in smaller, up-and-coming businesses. This is where you'll find the highest risk, but, man, also the potential for some seriously huge rewards. Okay, let's switch gears to our next category, debt funds. So if equity funds are all about growth, debt funds are all about stability and income. They're investing in things like bonds, which is kind of like lending money to governments or big companies. This makes them a much less volatile or bumpy ride. They're really great for investors who want to keep their money safe or generate a steady, predictable income. And just like with equity, debt funds have different flavors too. Liquid funds, they're kind of like a high-powered savings account, perfect for stashing cash you might need in just a few days or weeks. Corporate bond funds lend to really solid, top-rated companies, giving you a nice balance of safety and return. And gilt funds, well, they invest in government securities, which are about as safe as it gets because there's almost zero risk of the government not paying you back. But what if you're thinking, I want a little bit of both? Well, that's exactly where hybrid funds come into play. They're designed to give you a balanced approach by mixing stocks for that growth potential and bonds for stability. The whole idea is to catch some of the market's good days while using the bond portion as a cushion when things get rocky. It's like having a built-in shock absorber. Now, let's touch on index funds and ETFs. Both of these are built to do one simple thing: copy a market index, like the Nifty 50. But here's the key difference you need to know: how you trade them. With an index fund, you buy or sell at a single price that's set at the end of the trading day. An ETF, on the other hand, trades all day long, just like a regular stock. So its price is constantly changing, giving you the flexibility to buy or sell whenever the market is open. Okay, so we've covered the main types of funds. But when you put your money into one, what are you actually buying? It's time to pop the hood and take a look at the engine inside, the fund's portfolio. One of the very first things you should look at is the sector allocation. A chart like this shows you instantly where the fund manager is placing their bets. Banking, IT, pharma, whatever it might be. This isn't just a list, it's a peek directly into the fund's strategy. It tells you if it's spread out across many areas or if it's really focused on just a few key industries. And that brings us to a really important strategic choice. Do you go for a concentrated fund, like a sector fund, that bets big on one industry you really believe in? That's high risk, but also has the potential for really high rewards? Or do you pick a diversified fund that spreads your money across many different sectors? This lowers your risk if one industry has a bad year and aims for more consistent, balanced growth over the long haul. Hey, you want a pro tip? Always look at a fund's top holdings. The top 5 or 10 stocks in the portfolio, that's where the fund manager is placing their biggest and most confident bets. This gives you a crystal clear look into their strategy and shows you whether they're betting on stable, established companies or more aggressive, fast-growing ones. All right, so you've found a fund and you think you like it. But how do you actually know if it's any good? It's so tempting to just look at how it performed last year. But believe me, that's only a tiny piece of the story. let's talk about how to evaluate a fund like a real pro. This right here is the golden rule of fund evaluation. A fund's performance means almost nothing by itself. You have to compare it to two things: its benchmark, like the Nifty 50, and its peers, the other funds in the same category. This is where a key number called alpha comes in. A positive alpha means the fund manager actually beat the market, adding real value. A negative alpha? Well, that suggests you might have been better off just buying a simple, low-cost index fund instead. And of course, we've got to talk about risk. Now, to measure how bumpy the ride is, that's market volatility, we use another number called beta. If a fund's beta is 1, it moves right along with the market. If it's over 1, it's more volatile. Under 1, it's less. But to really get the full picture, the pros look at something called the Sharpe ratio. It basically tells you how much bang you're getting for your buck, how much return you're getting for the amount of risk you're taking on. And with the Sharpe ratio, higher is always better. Behind every single mutual fund, there is a human element. So let's talk about the people who are actually managing your money, the fund managers, and just as importantly, how they get paid for what they do. This is a huge difference. With active management, you're paying a team of professionals to do a ton of research, analyze trends, and try to pick winning stocks that'll beat the market. With passive management, the fund is basically on autopilot. It just copies an index. So what's the key takeaway here? Because there's no active stock picking, passive funds have much lower fees, and that can make a massive difference to your returns over the years. So what is this fee exactly? It's called the expense ratio. It's a small annual percentage that the fund charges to cover all its costs. Now, this fee is taken right out of your investment returns. So here's the crucial point. A lower expense ratio means more of your money stays in your pocket, working and compounding for you. And this brings us to one of the most powerful choices you can make as an investor. When you buy a fund, you'll see options for a direct plan or a regular plan. Regular plans include a hidden commission for an agent or distributor, which makes their expense ratio higher. Direct plans have zero commission, which means a lower expense ratio and, you guessed it, significantly higher returns for you over the long run. It's a no-brainer, really. And finally, let's tackle two of the most important questions every investor has. First, is my money actually safe? And second, how are my profits going to be taxed? The short answer here is yes, your money is very well protected. The entire mutual fund industry in India is heavily regulated by SEBI. There are super strict rules for transparency. But here's the most important part. Your money is not held by the fund company itself. It's held by an independent custodian. And that adds a really powerful layer of security for you, the investor. Okay, here's a super simplified look at taxes. And just remember, tax laws can and do change, so it's always a good idea to talk to a professional. But generally, for equity funds held over a year, your gains are taxed at a flat rate of 12.5% on anything over 1.25 lakh. For debt funds, it's a bit different. Your gains are just added to your regular income and taxed at whatever your personal tax rate is. The main thing to remember is that how long you hold an investment can make a really big difference in how much tax you pay. Whew, we have covered a lot of ground today, from all the different fund types and risk metrics to fees and taxes. But the learning never really stops. So I want to ask you, what's the next piece of this big puzzle you'd like me to break down for you? Drop a comment below and let me know what you're curious about. If you found this explainer helpful, it would mean the world if you'd subscribe and maybe share it with someone who could use it. Thanks for tuning in to Live Rich and Leave Rich by Krish.